welcome back to the deep dive. You know, if you're really trying to get under the hood of a business, understand its actual financial health, not just the glossy version, well, there's one place you absolutely have to look. Today, we're diving deep into the statement of cash flows, the SCF.
It's where the rubber meets the road, financially speaking.
Exactly. You hear that phrase all the time, right? Cash is fact, profit is opinion. Today, our mission is to show you precisely why that's true. We're going into the engine room, stripping away all the accounting guesswork, the estimates,
The assumptions.
to find the ultimate ground truth, what cash actually came in, what actually went out.
And we're going to compare it directly with the income statement, which, while important, can sometimes paint a misleading picture. We'll look at a classic, catastrophic example, Enron, to see what happens when that gap between profit and cash gets exploited. And then we'll wrap up by looking at how the really smart investors, like Warren Buffett, use cash flow concepts to figure out what a business is truly worth.
Okay, let's jump right into that core tension then, this profitability paradox. How on earth can a company report millions in profit, look great on paper, but, suddenly can't make payroll and goes bust?
Yeah, it seems bizarre, but it comes down to those two key statements being built on totally different rules. The income statement runs on the accrual basis. The whole point of accrual isn't really tracking the physical dollars in the bank account day to day. It's about matching revenues to when they're earned and expenses to when they're incurred.
Right, trying to give a smoother picture of performance over a period, even if the cash hasn't shown up yet or hasn't been paid out yet.
Exactly. Think about a big construction project, maybe takes 2 years. If you only counted the cash when the final payment arrived in year 2, well, year 1 would look like a disaster, right? Accrual accounting tries to spread that revenue and cost more evenly, matching effort with reward in the period it happens.
Okay, so what are the key rules driving that?
2 big ones. First, the revenue recognition principle. Basically, you record revenue when you've substantially done your part of the deal, delivered the goods, performed the service, not necessarily when the cash hits your account. You could sign that huge $10 million deal today, record the revenue now, but maybe you won't actually get paid for 6 months.
And bam, right there, you've got a potential gap between reported profit and actual cash in hand.
Absolutely. And the second rule is the matching principle. This says you should record the expenses that help generate that revenue in the same period. And this leads us to probably the biggest, most common reason profit doesn't equal cash, which is non-cash charges. Think depreciation and amortization, or D&A.
Ah, yes, depreciation.
Yeah.
Always a bit confusing.
Well, think of it like this. A company buys a huge machine, costs $50 million cash up front. That cash is gone, left the building. But that machine is expected to last, say, 10 years. Accrual accounting says, hold on, that machine helps generate revenue for 10 years. So instead of expensing the full $50 million cost in year 1, you spread it out, maybe $5 million a year for 10 years as depreciation expense.
Okay, so that $5 million expense reduces your reported profit each year and lowers your taxes, which is good.
Right, but critically, that $5 million depreciation expense isn't a cash outflow in that specific year. No cash actually leaves the building because of depreciation. The cash left years ago when they bought the machine. That difference, that non-cash expense, is a major reason why the profit number on the income statement is almost never the same as the cash flow.
Got it. And that's precisely where the statement of cash flows comes in. It cuts through the estimates, the timing differences, and just shows the cold, hard cash, liquidity, solvency.
And it breaks it down neatly into 3 sections.
First up, and arguably the most critical, cash flow from operating activities, or CFO. This is the cash generated from the company's core day-to-day business, making and selling stuff, providing services. If this number isn't consistently positive and healthy, well, that's a big red flag, right? Yeah. The fundamental business isn't generating cash.
Absolutely fundamental. Then second, you've got cash flow from investing activities, CFI. This section tracks cash spent on or received from long-term assets. The big item here is usually capital expenditures or CapEx, buying property, plant, equipment. Factories, machines, that sort of thing. Usually for a company that's growing, you actually want to see this be negative. It means they're reinvesting cash back into the business for the future.
Makes sense. Investing in growth. And the third piece.
Cash flow from financing activities, CFF. This shows the cash flow between the company and its owners and lenders. So issuing new stock or taking out loans brings cash in. Paying dividends, buying back stock, or repaying debt means cash goes out. It basically tells you how the company is funding its operations and investments through debt, equity, or its own earnings.
Okay, so we have these two different views. The accrual-based income statement showing profit and the cash-based SCF showing, well, cash. How do they link up?
Ah, that's the crucial part. They have to reconcile. And the way they do it, usually through what's called the indirect method, is incredibly revealing. It helps you assess the quality of the earnings reported on the income statement.
Right. This reconciliation is where you can really start diagnosing things. So walk us through how that works. You start with net income, right? The bottom line from the income statement.
Exactly. That's your starting point. Now, remember how net income was reduced by things that weren't actual cash expenses this year, like depreciation?
Yeah, the $5 million example.
So the first step is to add back those non-cash charges, like D&A. Because net income was lower due to that expense, but no cash actually left, we add it back to get closer to the actual cash flow.
Okay, add back D&A. That makes sense. Then comes the part that often trips people up, the changes in working capital, short-term assets and liabilities.
Right. This can seem a bit backward at first. Let's take accounts receivable. That's money customers owe the company. If accounts receivable goes up during the year, what does that mean for cash?
If receivables go up, it means we've made more sales on credit. So we've booked the profit, but haven't collected the cash yet.
Precisely. You nailed it. Your income statement shows the profit from those sales, but the cash is still sitting with your customers. So an increase in accounts receivable has to be subtracted from net income in the reconciliation. It represents profit booked, but not yet received in cash.
Okay, inverse relationship for operating assets like AR. Got it. Now, what about the other side? Operating liabilities like accounts payable, money the company owes its suppliers.
Same logic, but flipped. If accounts payable increases, it means the company has received goods or services, probably recorded the expense, but hasn't paid its suppliers yet.
Oh, so they're holding on to the cash longer, conserving cash.
Exactly. They've essentially gotten a short-term, interest-free loan from their suppliers. That preserved cash needs to be reflected, so an increase in accounts payable is added back to net income when calculating CFO.
Okay, this reconciliation process itself sounds like a powerful analytical tool.
It really is, because if you see a big and especially a persistent gap between net income and cash flow from operations, say net income is climbing steadily, but CFO is flat or even declining.
That's a major warning sign.
Huge red flag. It suggests what we call low-quality earnings. Maybe the company's recognizing revenue way too aggressively, leading to receivables piling up that they might never collect. Or maybe they're desperately stretching out payments to suppliers just to keep cash flow positive, which isn't sustainable. The income statement asks, is the company profitable on paper? The SCF asks, is it solvent? Is it generating real cash? You need both, but cash is the ultimate reality check.
And when that reality check gets ignored, or worse, deliberately obscured, you end up with disasters like Enron back in 2001. That wasn't just bad luck. It was like a masterclass in deceptive accounting.
Oh, absolutely. Enron's whole strategy was basically built on making the income statement look amazing, using very aggressive, though sometimes technically legal at the time accounting, while hiding the fact that the underlying business was just bleeding cash. Two main tricks. First, mark-to-market MTM accounting. For their long-term energy contracts, they were allowed to estimate the total profit over the entire life of the deal, sometimes decades, and book all that estimated profit immediately in the current period.
Wait, so they could sign a 20-year deal and claim 20 years worth of projected hoped-for profit on day one?
Pretty much. You can imagine how easily those profit estimates could be. Well, optimistic. It created billions in these massive non-cash paper profits. And second, they used thousands of these complex special-purpose entities, SPEs, off-balance sheet partnerships, basically to hide enormous amounts of debt and dump underperforming assets, keeping them off the main company's books.
So the income statement looks great, the balance sheet looked clean, but the cash situation must have been diverging massively from those reported profits. Didn't analysts see that on the SCF?
They should have, but Enron knew that. So they went a step further and manipulated the statement of cash flows itself. This was the really insidious part. They set up these deals with big banks, JP Morgan, Citigroup, called prepays. Structurally, these looked a bit like commodity trades, but in economic substance. They were loans. The banks gave Enron cash up front, and Enron had an obligation to repay.
Okay, so that's debt. That cash inflow should definitely be under cash flow from financing activities, CFO.
Absolutely, but that's not what Enron did. They fraudulently classified the cash coming in from these prepays, these loans, as cash flow from operating activities, CFO.
Whoa. Why? What did that achieve?
It created the illusion that Enron's core energy trading business was a cash-generating machine. It made it look like all those huge mark-to-market profits were actually turning into real operating cash flow, validating the entire model. It disguised the fact that the company was actually burning through cash in its operations and was only surviving by taking on more and more debt, cleverly hidden as operating cash.
That's staggering. Do we know the scale of that misclassification?
We do. In the year 2000, Enron reported a healthy, positive CFO of about $3 billion. But after investigators went through and reclassified those prepays correctly, the actual CFO was a negative $154 million.
Good grief. So instead of generating $3 billion from operations, they were actually losing $154 million, surviving entirely on borrowed money disguised as operating success.
Precisely. It was a house of cards built on accounting manipulation, particularly attacking the integrity of the SCF.
And the collapse, of course, led directly to the Sarbanes-Oxley Act, SOX, in 2002. A massive regulatory overhaul.
Yeah, SOX was forged in the fire of Enron and other scandals like WorldCom. It aimed directly at preventing that kind of fraud. Sections 302 and 906, for instance, require the CEO and CFO to personally certify the accuracy of the financial statements. Put some real skin in the game. Section 401 cracked down on those off-balance sheet SBEs, demanding better disclosure. And Section 404 required audits of internal controls. It was all about restoring trust by increasing transparency and accountability. The core lesson. You have to look at the cash flow details, not just the headline profit number.
Okay, so that's the cautionary tale. Let's shift gears now from failure to more sophisticated valuation. Thinking like the best investors. You mentioned Warren Buffett earlier. He's famously critical of just using net income or even EBITDA, right?
He is, especially EBITDA, earnings before interest, taxes, depreciation, and amortization. A lot of companies love reporting EBITDA because it makes their results look better. But Buffett sees a huge flaw. By adding back depreciation and amortization, EBITDA basically pretends that assets don't wear out or need replacing. But they do. A business has to spend cash just to stay in the same place, replacing old equipment. Buffett calls this maintenance capital expenditure.
Right. So EBITDA ignores the very real cash cost of just maintaining the current level of operations.
Yeah.
If you don't subtract that cost, you're inflating the cash flow that's actually available to the owners.
Exactly right. Buffett's whole focus is how much cash can an owner realistically pull out of this business over time without harming its competitive position. To get at that, he came up with his own metric. Owner earnings.
Okay, what exactly is owner earnings?
He defined it back in his 1986 shareholder letter. It's essentially net income plus non-cash charges like D&A minus the average annual amount of capital expenditures the business needs just to maintain its long-term competitive position and production volume.
That last part is key. Subtracting the maintenance CapEx. Not all CapEx, just the amount needed to keep the business running as is.
Precisely. That gives you the truly discretionary cash flow, the amount an owner could theoretically pocket each year without damaging the business's future. It's the cash left after all the essential repairs and replacements are done.
So how do we calculate that using the financial statements we have? Where does the SCF fit in?
Well, the SCF gives you the starting points. You can approximate owner earnings. The formula people often use is cash flow from operations minus maintenance capital expenditures.
Okay. CFO minus maintenance CapEx. That sounds like a really insightful number. And actually, for listeners who are interested in tracking market valuation through a Buffett-like lens, there's a neat tool. You can search for and download the iOS app Buffett Indicator right from the Apple App Store. It helps keep tabs on that broader market perspective.
That's a useful connection.
But calculating that owner earnings figure.
Yeah.
You said CFO minus maintenance CapEx. How do you figure out just the maintenance part? That sounds tricky.
It is the trickiest part, and it requires judgment. Because the statement of cash flows in the investing section, it just gives you one number for total capital expenditures. It doesn't break it down for you into maintenance CapEx, the cost to replace worn-out assets, stay compliant, basically keep the lights on, versus growth CapEx, the spending to expand, enter new markets, launch new products.
So the statements don't give you the split. The analyst has to estimate it.
Yes. You have to understand the business. How old are its assets? What industry is it in? How much does it realistically cost just to sustain the current level of operations year after year? That's the maintenance portion. Anything spent above that is likely for growth. For example, a mature utility company might spend a lot on replacing old pipes that's mostly maintenance. A fast-growing tech company spending on new data centers, that's mostly growth. It takes real analysis.
Okay, that makes sense. It requires digging deeper than just the reported numbers. Is there a simpler, maybe more conservative way if that estimate is too hard?
There is. A very common and useful metric is free cash flow, FCF. The most basic calculation is just cash flow from operations minus all capital expenditures. Essentially, FCF conservatively assumes that all CapEx is maintenance CapEx. It tells you the cash left over after the company has funded its operations and all of its investments in fixed assets. It's a lower number than owner earnings would be, but it's straightforward and still very powerful.
Got it. So whether you're estimating owner earnings or using FCF, the statement of cash flows is absolutely fundamental.
It's indispensable. It's the check on reported profits. It's a key tool for spotting potential manipulation like with Enron. And it's the essential starting point for any realistic valuation, grounding you in economic reality, not just accounting conventions.
And really, that understanding forces a shift in how you think about analyzing companies. You move from just passively reading the numbers to actively thinking like a business owner. What cash is really being generated? What have to be spent to keep it going?
Exactly. Accounting rules change, standards evolve, but the basic physics of business don't. Cash has to come in, cash has to go out. Survival depends on having more come in from your core operations than goes out over the long term. So the final thought, the question you always need to ask yourself when looking at any company is, okay, after they pay for all the necessary upkeep, the repairs, the replacements, just to keep this thing competitive, what's actually left in the till for the owner? That truth, that bedrock economic reality, is really only visible when you look closely through the lens of cash flow. Find that answer, and you're well on your way to understanding the true value.